Hello, welcome back. This is Professor Marsh, and this is Principles of Financial Accounting. We're now going to move into Unit 10. This is the first lecture for this unit, and I'm focusing on the matters that I want to highlight in Chapter 9. Chapter 9 is titled Accounting for Receivables, and in this chapter we have a lot of material with respect to the revenue recognition principle and putting accounts receivable on the books with respect to sales, but then also how to account for uncollectible accounts using both the balance sheet and income statement approaches, and determining the efficiency. So we're going to have another financial analysis technique that we're going to learn about with respect to the efficiency of receivables management using financial ratios. That is the third section in this chapter. And then we're also going to look at the role of accounting for receivables and earnings management. Now, this is something, earnings management is a controversial topic because oftentimes earnings management is used in a incorrect manner by people who are trying to manipulate their earnings per share in public companies. But we'll take a look at what this means. We're going to skip over revenue recognition principles in long-term projects or long-term contracts, and then we're going to look at also the how notes receivable and accounts receivable differ, and a comprehensive example of a bad debt estimation. And I may actually do a separate lecture for the bad debt estimation. So let's see how far we go with this lecture. I really don't want to go more than perhaps another 20-25 minutes or so. This is some pretty heavy stuff. And as we get to these later units, I want to give you a flavor for what this work is, but this is the type of work that you're going to dig more deeply into as you get further into accounting. You'll get back into this as you get into intermediate accounting, and also some of the topics will go into cost accounting, particularly with respect to inventory and cost of sales and the manufacturing process. So, but let's go ahead and go to the first section, 9.1, and the revenue recognition principle and how it relates to current and future sales and purchase transactions. And so in this section, we're looking at the revenue recognition principle in some detail. Now, we'd mentioned it before as one of our principles, assumptions, and conventions, but this principle states that companies must recognize revenue in the period in which it is earned, and it instructs companies to recognize revenue when a four-step process is completed. This may not necessarily be when the cash is collected. Revenue can be recognized when all four of the following criteria have been met. There's credible evidence that an arrangement exists, and an arrangement could be a purchase order, a contract, or some other evidence that there is a sale taking place, that goods have been delivered or services have been performed, that the selling price or fee to the buyer is fixed or can be reasonably determined, and four, that there are reasonable assurances that the amount owed to the seller is collectible. So that's the accrual accounting method as well. It aligns with this principle, and it records transactions related to revenue earnings as they occur, not when the cash is collected. If you're doing cash basis accounting in a small business, you don't need to worry about this. You only enter sales, you only enter revenue as the cash comes in. But when you're doing accrual accounting under GAAP, then you have to look at the revenue recognition principle and determine whether you can recognize that revenue. And the book gives you an example of the landscaping company that does landscaping and also sells gardening equipment. Okay, so accrual accounting has the revenue recognition principle. Then there's also a matching principle, which says that expenses should be recognized at the same time that the revenue associated with those expenses are recognized. So that matches the expenses with the revenue generated. And that is also a principle that we have. The reason that we want to learn this carefully and certainly understand it carefully is because there are many issues, many ethical issues that deal with revenue recognition. And there have been a number of scandals, a number of accounting and financial scandals that involved investors who were defrauded with companies that recognized revenue when they really didn't have the revenue and shouldn't have recognized it under GAAP. So that's something that you should take a look at. You might also, if you're interested in gift cards, just take a look at the gift card revenue recognition. You might be surprised with that and how that's treated for accounting purposes. So and again, we're rehashing some things that we've gone through before, but we're learning them in more depth. So a receivable, an account receivable, that's an amount that's owed to a entity from a customer. So one specific receivable type is called accounts receivable. Accounts receivable is an outstanding customer debt on a credit sale. So the company is expecting to receive payment on the accounts receivable within the company's operating period, which is the current period or at least within a year. So accounts receivable is an asset, excuse me, and it is a current asset. And so you see the example in section 9.1 of the Billy's Watercraft Warehouse, which sells various watercraft vehicles, and they extend a credit line to customers purchasing the vehicles in bulk. And you see an example of a customer who purchased 10 jet skis on credit at a sales price of $100,000. And the cost of the sale to the company that is selling it is $70,000. And so here's the journal entry that you have. And this is the simple example of a sale on credit out of merchandise inventory. So you've got a debit to accounts receivable that recognizes the revenue. You have offsetting credit as to sales revenue, and that records the sale of the jet skis. And then you charge the inventory. So you recognize an expense of $70,000 for the cost of those jet skis that were sold, and then you have the credit to reduce merchandise inventory that records that entry records the cost of the sale. So that's what you set up on the books. You have a $100,000 account receivable on the books, and then when the customer later pays on the account, and we all hope that they pay if we're taking the position of the merchant, then when they pay, we collect the cash. And when you collect cash, that is a debit to cash. And you increase cash. Cash is an asset. It's the first of all of our current assets, first asset that always goes on the balance sheet. And so we collect that $100,000 and we debit cash. And then the offsetting entry, so our debits equal our credits, is to reduce accounts receivable by $100,000, and reducing the asset account for accounts receivable is a credit entry. And so we're just reducing one asset because we've replaced it with another asset. We've replaced $100,000 worth of accounts receivable that we build with $100,000 of cash that we have in the bank. And so that the entry The notation on that is to record payment in full. Now, if we were journalizing this for real, what we would do is we would also put in the date, and if we had a chart of account and accounts numbers, we would also put in the chart of account and the account numbers. Okay, now that's that example. Now, the book also takes you through what happens if there had only been a partial payment. So what if the customer had only paid $75,000 of the $100,000? What would you do then? And so at this point, what you would do is you would record the $75,000 cash payment, and you would, just as in the prior entry, the offsetting credit entry would be to reduce accounts receivable. But in your accounts receivable balance and in your sub journals for this particular customer, in your sales journal and receivables journal, you would still have $25,000 on account that for the credit that you had provided to this particular customer. So at that point, you'd still have the $25,000 outstanding in accounts receivable. Now, there's another type of transaction, another credit type of credit transaction that requires recognition when a customer pays with a credit card. For example, a Visa card, MasterCard, American Express, that sort of thing. And this is different than credit that is extended directly to the customer from the company. So you have the example in your book, this next journal entry, in which you have a sale of sale of inventory that cost you $150. We know the entry for that. But then we have sales revenue of $300, but it was paid on a credit card. And so what we do is we set this up as we book the asset at $285 because we have a $15 charge that we have to pay Visa. So we have accounts receivable from Visa because Visa is, as the credit card processor, is the one that's going to send us the money, not the customer. And then we also recognize the $15 expense, which is the sales charge, the service fee that Visa is going to charge us associated with this sale. So we've got a credit card fee of 5%. 5% of $300 is $15. That goes to credit card expense. We go ahead and recognize the expense at the same time as we recognize the revenue. We match it properly. And then we also set up the asset for Visa to reimburse us or to pay us the $285 when they process it and remit payment to the merchant account that we have. So that's our entry for the sale. And then to record the other cost of the sale, the cost of the inventory, we go ahead and debit the cost of goods sold for $150. Obviously, we mark up our goods 100%. If you were on Shark Tank and you told that to all those guys on Shark Tank that you mark it up 100%, they'd probably think that was pretty good. But if you marked it up 600 or 700 or 800%, they'd think it was even better, the way those sharks are. So then you reduce the inventory. The credit entry on recording the cost of sale is a reduction in merchandise inventory by $150. So that's that. And then when Visa pays us the cash, that's the next journal entry. So we get the $285 in cash, and that offsets the account receivable asset from Visa. So that's that. And then there's an example. There are a couple of your turns, the Maine Lobster Market and the Jamal's Music Supply, and you can see that. And I would encourage you, if you're just trying to practice this, to do the your turn exercises and just write them down in your notebook. If you copy them down word for word, it's going to give you the muscle memory of recording these types of entries and it's going to make your homework a whole lot easier. And if you don't do it now, then maybe get your homework open and find the homework problem for section 9.1, and it's going to lead you right back to a question that's similar to these your turn examples. Okay, let's go on to section 9.2, and this section in chapter 9 is dealing with accounting for uncollectible accounts using both the balance sheet and the income statement approaches. And so sometimes in this world you have people who promise to pay you and they don't pay you, and I know that in my law practice has happened many times, and hopefully not for a lot of money, but occasionally that does happen. And so we have accounts receivable outstanding when we bill for our services, and then we find out that we have customers who either can't or won't pay us, and we have to adjust if those accounts receivable. Now, when I say we, I mean the hypothetical we, who is an accrual basis accounting practitioner, because if you're using GAAP, you have to use accrual basis accounting, and you have to set up your accounts receivable when you provide services or deliver the goods. Actually, in fact, as I've mentioned a few times throughout the semester, most small businesses, including our accounting practice and many others that certainly the vast majority of our clients pay their taxes with cash basis accounting, and so they also prepare their financial statements using cash basis accounting. But we're going to be learning accrual basis accounting, so we're going to have accounts receivable, and we need to have a process for calculating. Because of conservatism, we need to recognize a certain percentage of these customer accounts as possibly being bad debts or an allowance for doubtful accounts. And so this is the section that teaches us how to do that. Now, there are a number of different methods. Certainly the one that we use as cash basis taxpayers is the direct write-off method, since we're not really recognizing the income. We just, when we write it off, okay, we didn't collect it, and that's that. And the Internal Revenue Service certainly prefers the direct write-off method, in that you don't write off bad debts until they're incurred. But GAAP still requires that an accrual basis method be used for financial statements. So, how do you do this? How do you calculate this? You can have the first example, the customer takes out a $15,000 car loan, expected to pay the amount in full before December 1st, 2018, and assume there was no interest charged. And when the account defaults for non-payment, just a short time after that, then the company would debit bad debt expense and credit the asset, credit accounts receivable. So you'd be taking in expense. You'd already taken in the revenue for the sale of the car. Maybe you sold it, for $35,000. You got $20,000 in cash, and then this was just the balance that you financed. So you've already booked the revenue. So when you don't collect the debt part of that transaction, you have to write off the bad debt expense and also write down the asset. So that example is right there, dated December 1st. In the if any part of the debt is subsequently recovered, let's suppose that the customer just pays late. Suppose you threaten to repossess the automobile, and then a few months later the customer actually pays you, then you would reverse that entry. You'd put the accounts receivable and bad debt expense back on the books as they had been before the write-off. And then when you collected the cash later that same day, or perhaps simultaneously, then you would go ahead and record the collection of cash. Remember, that's a debit when you collect the cash, and then offset the accounts receivable that you had just restored to the books. So that takes the expense off the books and puts the cash back on the books and washes out the accounts receivable. So that's how you handle that sort of transaction. Now, those are direct methods. The most widely used method is the allowance method. This is where you calculate, based on some statistical analysis of your receivables, how much you expect to go bad. And this is certainly a calculation that is done by most of the credit card companies and a number of the large merchants that have had some historical experience with bad debts. And of course, this is related to their own credit policies too, who they do business with. And different companies would have different levels of allowances for bad debt. If you're representing a bank, for example, and a bank that's making secured loans, it probably has a very small percentage of doubtful accounts. If you're dealing with car loans, that may be higher. A lot of times there's credit extended to less than perfect borrowers to allow them to get a vehicle, and oftentimes those are have a somewhat higher allowance required for doubtful accounts. And then you've got some of the lower end consumer finance transactions, sort of the Aaron Reynolds furniture kind of stuff, where people are buying overpriced furniture on credit, maybe stuff that used to be rentals, and a large percentage of those accounts go bad, at least large in comparison to many of the other credit transactions that are out there. So what you do is you estimate what percentage you think is, based on your history, is reasonable. In the example that we have in the book, it looks like there's 4,800 of an allowance for doubtful accounts against accounts receivable. This is a contra account to accounts receivable, and so the net accounts receivable is reduced from 90,000 down to 85,200, and that's how it's presented as the asset on the books. And if you actually collect more than that, then you write it up, and if you actually collect less than that, then you write it down. And usually what happens is that you state the total amount of your accounts receivable from point to point, and then you calculate the allowance from time to time. And so if your experience improves and you collect your receivables better than you were before, you're going to have a net increase in your assets because the contra account will be reduced going forward. So you can see the examples of that in the book in section 9.2, and you can see how those adjusting journal entries would work. So the book gives you an example where the allowance is increasing because you have more accounts, and you have a higher credit entry in the doubtful accounts account. So at the end of the period, when you do your calculation of what the allowance for doubtful accounts is, then if you end up with an increase in it, then you're going to have a debit entry to recognize the bad debt expense, and then a credit entry to increase the contra asset account, the allowance for doubtful accounts. And you can see that illustrated in the book. And there are a number of illustrations of that that you can see going forward. So the book takes you through bad debt estimation and how you come up with the both the balance sheet method and then also the income statement method, as far as what percentages, if you're going to use either accounts receivable or if you're going to use sales or credit sales as the method for coming up with your percentages. And you can see the examples here of how those calculations are performed. And this example with the heating and air conditioning company is a pretty good example to take a look at with the example of 5%. And they don't really give you a lot of detail as far as how to make these, how to determine which percentage is the correct percentage. If you go further into accounting, you're going to be able to determine this a lot more precisely. You're going to have more data. But let's go into section 9.3 in this book and look at the efficiency of receivables management using financial ratios. So in this section, we're looking at what kind of a job does this company do in terms of managing and its receivables and collections, and how does it also has a reflection on its credit policy. Is it excuse me. So are we selling to credit-worthy customers, and are we doing a good job in collecting from them, in providing them with the reminders or incentives that are necessary to turn those receivables into cash? And one of the ratios that we calculate in analyzing our receivables management is called the Accounts Receivable Turnover Ratio. And this ratio is just a calculation of how many times accounts receivable are collected during an operating period and converted to cash. And as you can see in the examples that are given, the higher the number, the faster you're collecting your accounts receivable, the better job that you're doing as far as receivables management and collection on those receivables. And obviously, if you're collecting them quickly, you're also dealing with credit-worthy customers. And then another receivables ratio that's often looked at is the number of days sales in receivables. Now, in this case, the larger number is an indication of bad receivables management. So if you've got 180 days sales in receivables, well, heck, you're a half a year behind in collecting for what you're doing, right? So that's not a very good job either. And so in order to do these calculations, you typically have to look at a number of consecutive statements so that you can do the appropriate calculations. So as you look at table 9.1 and look at the calculation of comparisons of ratios, the industry competitor to Billy's Watercraft Warehouse, and how do they compare? Obviously, if you're turning accounts receivable faster and the days sales in receivables is decreasing, then you're doing a better job over time. And so you can see that This is a situation in which the the ratios are improving from 2016 through 2018. And then there's also a your turn, investors looking to contribute to either company A or company B, and ask you to calculate whether you prefer company A versus company B. So you can see the company A obviously is doing a very fast job of collecting its receivables. But you might need more information, just since the level of sales are different too, and there might be more information than just receivables turn that the investor would want to know. So your accounts receivables turnover ratio is defined as the net credit sales divided by the average accounts receivable. And what are the average accounts receivable? Well, you take beginning accounts receivable, ending accounts receivable, add them together and divide them by 2, and that gives you your average. So that's going to be the denominator, and then net credit sales for the year is the numerator, and that gives you your turnover ratio. And then days sales and receivables ratio is you take 365 and you divide it by the turnover ratio, and that tells you how many days it takes for you to collect your receivables on average. So anyhow, that's an important management tool, and that's also an important part of financial analysis. So now you know the quick ratio and current ratio and some of these other ratios that we've learned during the semester, but now we're starting to learn some more sophisticated management ratios that are used in business. Let's go on to section 9.4, and then I think we're going to stop this lecture because it's already taken me longer than I had planned initially. And so, we've only got about 30 minutes more to do some other things. So I better shut this one down and then go on to the next lecture. So in section 9.4, this is the role of accounting for receivables and earnings management. And these are the ethical considerations that they're talking about Enron and some of the really the fake and fraudulent income that they reported in their energy business. And then you've got some discussion of balance sheet accounts receivable and a balance sheet receivables aging list. So you have a certain number of receivables that are out a short period of time, and you can see that you've got I think this is really this is a great comparison of the 3 major types of calculations that are used to calculate the allowance for doubtful accounts and the bad debt expense. So the income statement method, you have a percentage of credit sales. Balance sheet method, you have a percentage of overall accounts receivable. And perhaps the most widely used in credit analysis is the balance sheet aging method, where you look at the age of the receivables, and you usually take a very small percentage of the receivables, and then you take that are very recent, and then you take a larger percentage of the ones that are older, and then an even larger percentage of the ones that are very old. So once they get to 90 days past due, you've got a 30% write-off ratio on those receivables, and that seems certainly appropriate based on my history. So then you can see, obviously as a lawyer, we find it easier to collect receivables, even very old ones. But that's sort of my experience with clients, is that a 30% write-off for a 90-day past due receivable is appropriate. So I guess that's really the guts of section 9.4. I'm skipping 9.5. That was, just you were supposed to sort of skim that material. I'm going to do another lecture to come back and talk about the comparison of notes receivable and accounts receivable, and then also bad debt estimation, and do a comprehensive example of that. So with that, have a great day, and we're going to shut things down for right now, but we will be talking to you again sometime very soon. Have a super day. Bye-bye.